Welcome back. Correlation is a measure of how closely two investments track each other. So how can investors look at correlation and how does it fit into alternative investments? David Kaufman is president of Westcourt Capital. So David, give us some examples where an investor would be considering this idea of correlation.
Sure. Well, correlation comes into play really in two ways. Within a specific asset class, so let's use, for example, public equities, which almost everybody owns, you can use correlation can be either positive, negative, or zero. So it can only go from -1 to +1. So what someone would seek, for example, if they were trying to hedge their equity portfolio, would be they would try and have equities that are uncorrelated to each other to the degree that that's possible. And if you were having a hedged approach, which many true hedge funds do, they might, for example, have a portfolio of long securities, and they would hedge that with an inverse ETF, which is a pretty perfect negative correlation. So that's within a certain asset class. But what many investors try to do is they try to diversify their asset classes in order to achieve decorrelation. So for example, a perfect example of an alternative asset class that is classically decorrelated to public equities is real estate. Historically, real estate has a reputation for being an excellent inflation hedge, a source of income, capital preservation, capital appreciation, but at the same time, it has very low correlation when it's not publicly traded to the public markets.
So let's test that theory because, theoretically, if you could do that, it makes a lot of sense. But in this last financial crisis, in the last 36 months, very few supposedly uncorrelated assets were actually uncorrelated. And I'll take real estate and the public markets, for example. There are many hard assets, like real estate, that went no bid when the ability to borrow cash to buy it wasn't there in a financial crisis mode. Bonds also, that were supposedly uncorrelated to indices, also collapsed at the same time. So in a real crisis, does this strategy really work?
Probably not. There were a lot of people on the street in 2008 were saying that correlation of everything was approaching 1. And so it may not be a perfect, foolproof method of insuring oneself against precipitous falls in any particular security value. But in normal times and in good times, it's a good way to at least diversify one's exposure to risks in a certain area.
All right. So granted, the idea is when everything's going down, everything's going down. But in more typical times, there would be ways where you're wanting to diversify and have, these uncorrelated investments. Can you describe for us how you would use that in an alternative investing strategy?
Sure. A lot of the sort of classical alternative investments, real estate being the best example, but you can go offline into things like wine or art, or other types of classes that are considered, they don't tend to trade publicly, and because they don't trade publicly, they don't get marked to market every day. And so what would happen in theory is that they have intrinsic value, and that value will not be as volatile as that of the public equities. So even in 2008, everyone was on a bit of a roller coaster ride, but those people who had diversified among the asset classes and had alternative investments within that, including private equity, I might add, it may have been a more muted volatility. So the ride might have been somewhat less nauseating, but terrifying nevertheless.
I actually looked at fine art and wine funds, and I discovered that one of the challenges in how they market themselves is, yes, these things have beat many, many indices, particularly wine, but the cost of transaction of wine is not actually disclosed in this. For example, if you actually had $1 million worth of, let's call it 82 Latour, that you bought at $300 a bottle and now trades at $4,000, and you wanted to trade it, you have to pay 10 to 15% commissions to the auction house. And yet the fund marks to market at last night's auction price. So are they really that efficient when you drill down and look at it from a dollars to dollars basis?
Well, more than anything, that might be a good reason to go long on Christie's or Sotheby's if they're making those sorts of fees on the auction. But it's certainly important to note that because management fees, which we talk about all the time, are not the only drag on investor returns. So when those transaction costs get high, and I might add that real estate transaction costs are also very high, where by the time you've listed a property and had the broker's commission paid and the other fees along the way, it could cost 6 or 7% as well. That really what one should try to discover to the extent that you can is what the net returns are if you're trying to measure not only the correlation but the potential for positive returns.
You know, hearing Kevin talking about, you know, the fine wine investments, fine art, and all the rest of it, I mean, how common is this for more average investors, not your Kevin O'Learys of the world, to be using this sort of strategy?
You know, I think some higher net worth individuals end up employing that strategy almost unwittingly because they have their own wine collection or they have their own art collection, and then they realize in turbulent times that, hey, the stuff hanging on the wall that I've appreciated during dinner these last few years is my greatest store of value, or jewelry, for example, that's made out of gold. But for the average person who buys, say, mutual funds, it is difficult, if not impossible, to be able to decorrelate to that extent because of the inaccessibility of that type of fund.
Right, interesting. Okay, thanks so much for explaining it to us.
It's a pleasure.
Well, now it's time for our